Hey guys, welcome to another video. In this video, I will discuss profitability ratios, which are part of our syllabus for managing finance. The first ratio which we are going to discuss is return on capital employed. It is commonly called ROCE. ROCE is a very well-known ratio. Before I tell you what ROCE means, it will be helpful if you look at the formula, and then the meaning of the ROCE would be pretty obvious after looking at that. ROCE is operating profit divided by share capital and reserves plus long-term debt. Operating profit is a figure which is given in the income statement. It is also called profit before interest and tax. So you should be aware that operating profit and profit before interest and tax are the same thing. This figure is then divided by share capital plus long-term reserve, which is basically total equity figure given in the balance sheet. There will always be a total equity figure in the balance sheet, so that figure can be picked up from there. The long-term loan is a bit more complicated area. Long-term loans are also called borrowings, or debt, or debentures, or loan notes. This figure will be available in the balance sheet. When you look at the balance sheet in the non-current liabilities, this is something which you need to investigate, that what are the figures which fall under long-term debt or long-term loans. A bit of reading would be required. So the problem here is that not all of the non-current liabilities are actually liabilities. In that section, most of the items are provisions. So you need to do a bit of research to find out what is the actual wording and the figure for the loan is. The second problem for the non-current liabilities is that some of that non-current liability is also given in the current liability. And the reason for that is that normally the non-current loans are the loans which we have to pay in the long term after 12 months. However, when you have taken the loan, some part of the loan would be due to be repaid in the next 12 months. So it would also be given in the current liabilities. So you should look there as well. The logic in the ROCE formula is that we make profit and then we divide it by all the capital which was invested to make that profit. The capital employed comes from two sources. One is equity, which is the shareholders' money, and other one is debt. So what happens when business starts, they need this kind of money to invest in the non-current assets of the businesses. So these two elements, equity and the non-current debt or the long-term debt, they are spent on the non-current assets, and they are supposed to be producing revenues. The current assets are not used for that purpose. So I hope the purpose of the return on capital employed makes sense. The higher this figure is, the better it is. We will discuss more this in another video where we will be calculating the ROCE of an actual company, and then this thing will make a lot more sense. The second ratio in the profitability ratios area which we are going to talk about is gross profit ratio. Gross profit is a figure which is calculated by deducting cost of sales from the sales figure. For example, if you spend £5 to buy a product and then you sell it for £10, your gross profit will be £5. This figure ignores the other expenses which may occur to run our business on daily basis. This figure can tell us the goodwill or the strength of a business in the market. So for example, a product which Tesco is selling for £10, it may be being sold by Marks and Spencer by £12. So the brand name actually helps businesses to charge more money and hence make more profit. The other thing is that this figure will be different in different sectors. So for example, if you're looking at Tesco, their gross profit will be less because they're selling fast moving consumer goods, grocery items, where margins are small. However, if you talk about electric cars, for example, the margins are pretty significant. So it does tell us a lot about our business. How it is calculated: if you look at the formula of gross profit ratios, it uses both figures from the income statement or statement of profit or loss. So we take gross profit and we divide it by the sales figure, and then we multiply with 100%, and this gives us the percentage of gross profit from the total sales. The benefit of using gross profit ratio is that it gives us a figure of gross profit out of 100. So for example, if you compare the absolute numbers given in the income statement of two different companies, so let's take an example of Marks and Spencer's and Burberry. You can see that these are the ratios of the gross profit and the sales. However, if you look at the absolute numbers, it does not really make sense. However, when we solve the formula, it gives us the gross profit out of 100, and that makes things a lot more easier to compare and to understand. So you will get a figure out of 100. So if you made 100 worth of sales, our gross profit would be this much, rather than looking at the millions of figure of gross profit out of billions of figure of the sales. One thing which is important to understand is that gross profit figure is not given for the service industries, because there is no cost of sales as such. They don't really buy something to sell something. So you may not find a gross profit figure for an airliner or for another company in the service industry. For those companies, this ratio is not that relevant either. Net profit ratio or profit margin ratio is another very important ratio, which tells us the profit made from every 100 pound worth of sales by a company. This makes things more comparable and understandable rather than looking at the absolute numbers. This figure should be calculated for every company. If you look at the formula for net profit ratio, we have profit before tax or net profit before tax. The figure of net confuses students sometimes, although it doesn't really mean anything. So it could be profit before tax or net profit before tax divided by total sales or total revenues. The problem with the profit figure is that sometimes this figure is used profit after tax, and sometimes this figure is used profit before tax. So that is an issue with it. The important thing is that if you are calculating ratios for two different companies, you use the same formula rather than different formulas. Sometimes when you calculate a company's ratio and then you search the same ratio on internet, you see a slightly different figure. And the reason for that is that they may have used a different figure. Both are fine as long as you're aware that a different figure or the formula has been used to calculate this ratio. If this ratio has increased over years, or if it's more than the last year, then this means that the company's performance has increased, and if it has gone down, the figure has gone down, then the company's performance has decreased. When we will calculate the figures for an actual company, it will make more sense. Quality of profits is a ratio which tells us how much of our profits were converted into cash, and it is very important ratio. And the reason is that if a business has been selling a lot, and because they're selling a lot on credit, they have been selling a lot to anyone without doing any credit checks. This is very aggressive marketing or selling strategy. They may not get all of their money from their customers because they have been selling to everyone. In that case, it is important to compare how much profit they are showing because of that aggressive selling strategy against how much cash they're actually receiving. And if they are not receiving a lot of cash, then it is detrimental for the business, because eventually they will run out of cash. It is also an important measure of the effectiveness of credit control of the organization. If you look at the formula, it uses two figures. It actually uses one figure from a statement of cash flow, and that is the reason that in some books this ratio has been given under the cash flow ratios. However, in essence, it does tells us about the quality of the profits of that business. So it uses one from a statement of cash flow, which is a net cash flow from operating activities, and then it is divided by the figure of operating profit. By standard, the result of this ratio should be 1:1. So if you are showing a profit of 1 million in your income statement, the actual cash which you have generated from that should also be 1 million. This ratio, however, will be different for retailers who are always who sell on cash, and this may give a high figure for this ratio. However, those businesses who sell on credit, they would normally have this ratio less than 1, so their net cash generated from operating ratios would be less than 1. The result of this would be in times, not in percentage.